today we're going to focus on public markets to private capital, and really going to talk about what how wealthy investors are reallocating this year. Specifically, using private capital, reduce volatility, and increase control. We'll talk about some different things like macroeconomics, talking about how to reallocate strategically, and also get into some retirement account blind spots. But big picture today, we want to come to you to provide something that's going to be of value to you. The one way we can do that is throughout this webinar, we want you to post in the comments in the chat questions you have, and we will get to them, as they come up. And then we'll have a little bit of time at the end. If there's a little more time for that, we can answer more questions as they come in. But please ask those as they come up. And this today, it's very conversational. I'm going to ask each of you specific questions, but if someone else wants to come in after that question and answer, or ask another question, this is a conversation like around a coffee table. That's how we're setting this up. So as that happens, feel free to do it. So we've got three studs here today, all in different ways, in unique ways, that are bringing something really valuable to the table. We have Bethany, we have Kylie, we have Andy, and I'd just love for you to share, a sentence or two intro about yourself, something that would help the audience get to know you a little bit more. Bethany, we're going to start with you.
Wow. It depends what you want to get to know about me. I think in the bigger scheme of things, the things that people care about, I'm 30 years in the real estate investing business, built multiple businesses, scaled multiple businesses, exited businesses that didn't make sense, gone multi cycles in various markets. So wide variety of experience. Most of it has been learning what I don't want, what I don't like, and what doesn't work. And through that process, the Lord has blessed me with some other wisdom that allows me to work well within teams to really navigate and pivot when things are shifting and or changing, or to meet a community's needs, for sure.
Kylie, how about you?
Yeah, well, so I'm Kylie. So my background and a little bit about me is I come from the HR space. This wasn't a space I originally intended to be in, but I fell in love with investing and sort of realized that I'm the middleman. HR is the middleman for investing and retirement, and realized there was a space that was missing. So that's sort of where I found my space. And a little just personal about me is I love to be outdoors with family and just blessing my community.
Awesome. Thanks for coming, joining us today.
Yeah, Andrew, I
Andy.
imagine I'd be curious to know how many hours you're outside, Kylie, because Andrew brags about the number of hours each year that he and his family spend outside. So,
Oh, I wish it was probably more, but with all our rain we currently are having, I'm avoiding the outdoors. So,
I also like how you guys
Yeah.
weren't offended that he called you studs. I mean, that's great. We still
no,
have
not
male
at all.
dominating terms that are
What about that? Is I'm
uh,
like, is studette the right word? I'm
Yeah,
like,
right.
I like studs. I think you guys
Hey,
guys
I'm
are
leaving
studs.
my
I like
HR behind, okay? I'm not even looking. I'm not even hearing.
So I've been in this game almost as long as Bethany, about 25 plus years, mostly in real estate, investing in businesses. And I'm really excited about this topic because I think this is one that we just kind of typically have a blind spot to as operators and constantly working in the private space, that we often compare our own portfolios that have some investments in the public space, but we rarely kind of make the distinction with the beta, the volatility that you would see in the public markets versus the private markets. So I'm excited to dig into this, and I think with Kylie's background and Bethany's background, this is going to be an interesting topic.
Awesome. Thanks, Andy. Yeah, and I'm Andrew Stimpson. I help run operations at Legacy Acquisitions. I'm a farm kid from Southwest Iowa. I grew up with hoop dreams, had a lot of experiences overseas, and have been in a number of businesses, much like Bethany mentioned, both successful ones and some that weren't. I've learned a lot of lessons along the way, and am really enjoying build to rent development, which is what we're really focused on at Legacy. All right, first question. I'm going to come to you, Andy. We're looking at kind of macro trends. And one thing we've seen in the last few years is volatility. And we've seen that in a number of different ways. I guess my first question is this something that is more temporary or cyclical, or is it more something more structural that's going on?
Yeah, it's interesting. I mean, look, so Bethany and I have been through multiple cycles, and so you're constantly hearing, "Hey, this one is just like one of those." Even though we know each one was different, right, for various reasons. I started in this game in the late '90s, so we had kind of the tech boom where we were, owning and operating office buildings, and had half of the tenants were tech companies, right? And so that blew up and that changed the way that people viewed all business, right? And then 2008, GFC, we were developing projects in Venice Beach. That was completely different because all of the money just completely shut down, right? There was no debt, no lending, period. It didn't matter whether you were a public or a private. Now, I think it's very interesting is that you've got so much more of an opportunity to invest privately in whether it's private equity, whether it's Fundera, whatever that app you want to pick up your phone and invest in real estate, that it's kind of changed the way that we can view volatility. Now, for instance, our projects are 5-year, 7-year holds, right? So if you've got the market sentiment goes one way for a project in a stock that you have, everybody thought Intel was going to be it, right? They're not even on the DJIA anymore. So I think that with our deals, we just have a lot more control in the private sector to operate them without the kind of additional market sentiment. They kind of call it this illiquidity, premium that you would, because we're paying out investors a little bit more of a return, but we know that we're using that money so that we can navigate through it. I'll let Bethany kind of take it from there, but that's kind of the way I see the differences now.
Yeah, well, and I think the biggest thing too, when you think through when the whole speculative agenda that comes out, right? Who's saying what, right? Is it an economist? Is it even the Warren Buffetts of the world, right? What are they saying? How are they saying it? When are they saying it? And who's listening to them? Are they listening to them, or are they trying to drive consumer sentiment a certain direction to make them do what they want so they can benefit from it? So really understanding that difference, just like Andy was saying, with there wasn't always access to the capital. Well, there was always access to the capital for the right people, right? In the right situations, in the right scenarios. So understanding how to play the game, I think really shifts that. And that's one thing that Andy has done so well for so long, is really understanding that macro, that big picture. So years ago, when we launched into the build to rent side of things, and we were actively praying and seeking, what are we doing and how are we doing this? And okay, Lord, we know you've got us here for a reason, but what does that look like? And we're praying through some things. Andy, with his big question, big question brain, is asking that question of, where's the world going? What are the needs? How can we meet those needs? And then how can we use our skills to help meet those needs? And so if your portfolio is waxing and waning based on market sentiment, or what the latest economist is projecting, is it really meeting your needs, or is it meeting their needs?
I sort of agree with you guys on the volatility side of things. I mean, I don't really have a lot of extra to go in. You guys have a lot more experience on that piece of things. But volatility is everywhere. So you just have to be able to manage it and be with the right partners.
Yeah. Andrew, one thing that I'm always kind of curious about as we're bringing in investors is, where is that capital coming from? And Kylie does a lot with, the 401ks and SDIRAs, and I don't know what the number that I saw, but it's got to be $13 trillion in these accounts that people kind of set and forget, right? They just decide, hey, look,
Yes.
the market is going to do the work for me because I know my manager is basically investing in the Dow or the DIG,
Yeah.
and they don't have this kind of access and autonomy. So I'm kind of curious about how that, it seems like over the last 5, 10 years, people were investing in that with them, but utilizing them now, thinking them more longer term as opposed to kind of shorter term.
Yeah, I
Kylie.
think it's coming down to like the strategy, right? I think a lot of people, we learn that a 401k or retirement's where we should go, but we don't get this strategy outside of that. And what I've seen over the last couple of years is people are talking about your self-directed IRAs, your whole life insurance, finding ways to actually use that money. It's no longer just sort of that set it and forget it type space. And that's, so it's been interesting watching people trying to navigate that piece of where they want to put their money, where it's going to be appropriate. And you see it go back and forth. Sometimes people are really holding it tight, and other people are a little more aware that they need to do something more. But it's, you hit it nail on the head with the autopilot. We need to get out of that autopilot sort of space.
I think it brings up
Eh,
a good question though.
yeah, go ahead.
Andrew, if we think through it, let's talk concentration risk.
There you go.
I mean, if all of you're basing your entire retirement in a 401k and all of it is concentrated in the S&P 500, we all heard of Enron, right? We all went through 0809. We all, yeah, I mean, there's things that, and then in that same cycle, even what's happening in the markets is there's a lot of speculative, and there's a reason certain investment groups make money even in down markets. What are they doing? They're shorting it. They're doing option, they're doing things strategically, intentionally moving away from concentration or taking advantage of concentration, but in turn, also recognizing the risk that's involved and getting the payout for that risk, right? So if we're looking at a 401k that's 100% in stocks, bonds, treasuries, it's all the same, right? So if 1929 happens all over again, what happens to your retirement? Right? Or like in the last couple of years, there were so many unfortunate situations. I'm not even going to say it was bad operators. It was inexperienced operators in the multifamily space that weren't purchasing the deals correctly. They didn't do enough on their underwriting side of things. They didn't buy rate caps. They didn't do certain things to protect their investors. And so now their investors didn't see good returns, didn't see the cash flow, didn't see. And so in the consumer space, right, multifamily is kind of getting this bad rap. But really, the asset itself still performed. What didn't perform? The underwriting, the operator, and how much of that can be controlled. So if you're looking at it from a concentration aspect, if you had part of your retirement in, say the S&P 500, and then you had part of it in real estate, and then you had part of it in crypto, and then you had another part of it in gold and silver, right? Think hard assets. And then you had another, something else, a business that's funding, right? Your concentration is spread out. But we know what happens when a market is oversaturated, it's going to correct. Andy is constantly talking about markets that are correcting, markets that are correcting, markets that are correcting. And I think that's kind of what we're dealing with right now, right? With all the inflation, right, Andy? Am I correct in what I'm saying
Yeah, I
there?
mean, I think like every market, and we know this because we've been invested in some of the larger markets, right? We've invested in some of the secondary, tertiary markets, even in the down cycles as a whole, what we would consider GFC or 2000 after 9/11, any of those, there was always markets that were ascending. Now, maybe you weren't getting the huge growth returns in some markets and rents, et cetera, but you might be getting appreciation, or maybe you weren't getting a lot of appreciation, but you're still catching cash flow. So I think there's always ascending markets. And I think the other part of it is the inefficiency part that you hit on it. It's there is control in the private markets to navigate those inefficiencies, right? We don't, if Bethany tells me we got to let go of a property manager, or if there's if there's a, we don't have to go to the board, you know, HR we do consider, Kylie, but not to the degree that we would have to if we're, you know, on a board of a large company, right? So there's a little more. Goldman Sachs did a study I thought was pretty interesting where they kind of took all of the investor wealth and they said, hey, look, these guys were investing in private equity deals, you know, and these guys were investing in public deals, REITs, companies, etc. And that the wealth disparity was like 12% more on their net worth over that 20 years, right? That's a pretty big number when you think about all the wealth created. So I know that you're not saying, hey, look, you know, don't invest in the stock market or don't invest in crypto. But the old days of when I grew up, they said, hey, you know, do your age, that's the amount of bonds that you should have, and the rest should be in stocks, right? So if you're
Yep.
40, you got 40% of your portfolio in bonds and 60% of it in stocks. And now we've got these opportunities where these private investors can get access to those deals that they didn't have access to before. So I think that's the part of it, Andrew. I know that, you know, we kind of took your question and chopped it up about 3,000 different ways, but hopefully we got to the heart of it.
Yeah, so let's dig a little more into the risk side of it. So, you know, you would hear, hey, you got to have this diversified portfolio, and and some of you spoken to it. A lot of times that diversified portfolio is within the stock market. And you might look at the last couple decades and be like, well, man, if you take what's happened over the last couple decades and you've consistently invested, you're doing pretty good today. But what's maybe a hidden risk or a risk that um, isn't as obvious as someone who is not diversified outside of public markets is really taking on. Bethany, let's start with you.
Yeah. Well, I think in that situation, one of the biggest one that always, 0809 always reminds me of how many people we know that lost their retirement, just wiped it out. And it had zero to do with them. It was, you know, the fund that was held and the markets tanked and it just wiped out all of that. So if you had 100K in your retirement, now you've only got 50K, even though the market might have continued to perform on average 7% or 6%, whatever that is, how long it's still taking you 10 to 20 years to recoup the 50K you already lost. So although the performance might have remained the same, which is the number a lot of folks look at, they're not looking at how much are you losing or how much are you gaining. And so, and how long will it take? Do you have the timeline? Do you have the runway left in your life to recoup those losses? I know in my mom's situation, she was done. She's like, nope, I'm done. I'm obviously gonna have to work until I'm gonna die anyway. So I'm pulling all that money. And she had zero faith in anybody in the system. And this is someone who grew up in an era where you worked for everything, which is, I mean, not unreasonable, but they didn't grow up with handouts, right? They went through, you know, some of the depression and some of that, and they went through and saw hard times. So their money, every dollar they even got into an account was a huge risk because they were still putting things under the mattress. So putting it into an account and doing all that. So it was so much more emotionally devastating. So to look at a number on a piece of paper and go, oh, well, the market overall makes 7% a year. That doesn't change what they lost during the time and how can they recoup it, right? So I think recognizing in the private markets, you have so much more flexibility, like Andy spoke to, that allows pivots to happen. If there's almost always indicators that can lead folks who are actively watching and paying attention to things. So if they're feeling like, I think there's going to be a correction in this, they could be pulling their funds, they could be moving it to a self-directed account, they could be even something simple as taking a loan against it and doing something different with it. There's things they could do and then put it into a private situation and get the good returns, at least feel like they're taking back some of the control instead of keep giving it to somebody else.
So, Andy, I'd love to hear. I mean, something I'm hearing, a theme is that in the private space, you can maybe be a little more agile when things come up or when things shift, things move quick. So I mean, give us a picture of what, something real that you maybe experienced or seen where that has shown to be the case, where,
Yeah, I mean,
maybe a
look,
football was thrown or something.
there's the other side of it too, right, Andrew? Like people would say, "Hey, well, man, I've got my money tied up in development project, or I got my money tied up for 5 to 7 years," right? So it's got to be a bespoke kind of allocation. All my point is really more that the way that the public market views is investment in general is more like a voting machine, right? Every day you look at what happened in the news and what happened around the world. We get in a war with Iran and what goes with oil, and I lose so these are all kind of, that's the voting machine with the private business. And again, this is kind of, we're given it's given that it's a strong operator that's reporting properly and that is making adjustments, right? That's kind of the given part of it. But assuming that's the case, imagine that does happen, sentiment, etc. You're still developing your project, you own them, the individual units. Let's just use, for example, our business, built to rent, right? So price of oil goes up, we got worry about concrete going up, we got to worry about lumber going up. Well, we've got individually platted units. We slow down or sell off 10 units at a time, or we decide maybe we're not going to go after that last 30 units that we're going to build because we think that our residents aren't going to be paid. Those things you can't necessarily do on a larger scale. So I'm only saying that as Kylie's business, that you've got these funds that you used to just kind of entrust with somebody else, and now you've got actual agency. Do you like crypto? If so, why and who? And who's going to win? Is it Ethereum or is it Bitcoin or who? There's a lot of considerations. But again, as Bethany said, these can be your considerations, or they can be somebody who has other kind of ancillary requirements and restrictions that he's dealing with, right? You don't. You can read, review, decide, and a lot of us aren't doing that with the retirement. I'd be curious to hear, Kylie, like just the people that you're working with or what you've seen, how they're benefiting from using their retirement funds.
Yeah, I mean, I've seen a lot of really good benefits because once people can sort of understand that their retirement, they can access that and they can utilize it in their own way, that's when the light bulbs happen. Because then we can start talking about what is it that you want to invest in? What is it that you have a lot of value in? So once I can start having that conversation, getting them excited with the self-directeds, then everything sort of opens up. All of a sudden, it's no longer untapped money, it's a whole bunch of potential. Because what I find is a lot of people look at retirement as they're saving for retirement. They're not using the word investing. So once you can switch that narrative with them, all of a sudden things start to click a little bit differently. So I see a lot of excitement. I see a lot of hesitation too. I mean, it takes a lot to get someone, I mean, as you all have seen, going from a retirement to a self-directed to get them into a project is a massive project in itself. But when you see that and when they can start seeing the repercussions, what I really like is when I'm working specifically with my HR professionals, is once I see that HR team click how this can be for them and their personal level, then it's how do we get this into that bigger scale? How do we get the information to more employees so that they can make better decisions? And that's what I love to do. That's where I'm in here is educating on there's other options. You don't just have to pick the one that you've been given that we were taught all along the way.
Is it, Kylie? Just a quick question on that. So
Yeah.
you handle IRAs and 401ks, or you've seen people kind of invest through those vehicles. 401ks is not typically known. So maybe, I don't know if you can speak to it. Maybe there's a bigger process. I think that if we just accept the premise that a lot of folks don't even know that they can invest any of their retirement, unless if they're with an employer, of course. But outside of that, I still feel like people just, hey, I'm going to trust whatever, they decide to tell me I should be, allocating.
Yeah. I mean, I think what I find a lot is that employees tend to have a 401k if they're in that space and they go through that route. I don't work specifically with self-directed. We have partners that we work with that do the self-directed piece. What I really focus on and manage when I was in the HR space was the actual HR admin of the 401k plans, learning what the plan summaries were. So that's where I sort of got my background on that. So that's where my education side comes in to help advocating for people to have a better understanding of what's out there. Because that's the thing is that you just don't know what you don't know. And unless someone piques your interest that there's more out there, that you actually do have opportunities, everyone just assumes they have one lane. So I work with a lot of employees or a lot of HR professionals. So I'm not always working with the business side of people or like the business owners. So they may not have those 401ks as often because they're going different routes, if that makes sense.
Bethany, coming back to you. So kind of getting back, you work with high net worth investors. What's something that separates, reallocation, of a portfolio from market timing?
So I think the thing to understand first and foremost, market timing generally refers to short term and it refers to predictions. So they think the market's going to go up, they think it's going to go down, and they think in this amount of time, oh, I want to move this, I want to move this, where um, reallocation is more on a structural basis. So you're looking at your portfolio and you're asking yourself, is this still meeting my needs? If so, do I need to shift or change things? For instance, in Kylie's HR world, when they're looking at providers, right? They may be looking at the cost, they may be looking at this, they may be looking at this. As investors, we're looking at maybe all these different fees, but we might also be looking at what that particular group offers. If they only offer public market traded stocks, bonds, things of that nature, and we're looking for an alternative asset, oil and gas, real estate, build to rent, private debt, any of that, then that may not be a good fit for us. So maybe we only apportion, say, 10, 15, 20% of our portfolio to that particular stock market and bonds and things. And then we put maybe another 20, 30% in real estate. And maybe we put another 40% in crypto, something along those lines. When we reallocate, maybe we determine crypto hasn't been performing where we thought, we've been taking some heavier hits. We needed it to be performing at X level and it's not. So we need to create more cash flow. Let's shift over to more debt. So they're looking at their portfolio as a whole, and it's structural based and it's holistic, where market timing is always just very short term. Oh, I think Intel's going to go down, I'm going to pull my stocks and I'm going to put them all in whoever, an index fund or whatever, right? So it's recognizing one is more longevity and is it meeting the goals of my portfolio, and one is short term, speculative, not necessarily it could be based on data, but not necessarily as much long term and just much more speculative.
So let's say someone has been primarily invested in the stock market and they're considering investing, in private capital. What kind of role does that play in risk management?
Yeah, so that is a great question, because if, let's use Kylie's example. Her employee comes to her and says, Kylie, I am worried the stock market's going to crash. All my retirement, I've worked so hard, it's in here. What can I do? Kylie says, well, we don't have a vehicle as a company. Our 401k is only invested in the stock market. Here are some other options. So sometimes a company will be able to present them and they can ask their HR departments. Sometimes, in fact, a lot of times, unfortunately, they don't. They don't know anything about it. The HR department literally just says, here's Fidelity's number, call them. And Fidelity is only going to offer the products that they have. So for instance, if I go to Chase Bank isn't going to sell me Wells Fargo's product. They're only going to sell me Chase Bank's products. So they're going to be limited. So you have to think about the source. If you're trying to reduce your risk, That pertains to you, what values you have, what you feel are risky or not what the other person's value is. So Fidelity's risk level and tolerance is completely different than your own. If this employee is concerned the stock market is going down, they want to diversify, there's no option there, going to Fidelity is not going to give them another option or source. So seeking out somebody like Legacy Acquisitions, Empower Her Capital Fund, different groups that offer things, then realizing how can I do it in a way that's tax efficient? Because it doesn't do you much good to do it if you pull it out of a retirement and then you invest it as cash, right? You lose all those tax benefits. You don't want to do that. You're doing this for a purpose. So if you want to reduce the risk, you want to keep it in some kind of retirement account. So that could be just like Andy was talking about, moving it over to a self-directed IRA, or if you're a business owner, into a solo 401k. A lot of churches and things will have a SEP, different other retirement tools. But creating it, keeping it in a retirement tool that you can then invest within that tool. So that most people don't know that their retirement account can actually become part of a debt offering or a debt fund. They can actually invest in an apartment building inside the retirement. And then all of the profit and benefits go in the retirement account, and then it grows tax free. Now, the
So
downside to
Bethany,
that, oh, I
oh,
was
go
just
ahead.
going to say the downside, the risk that you take is you lose on some of our build to rent aspects. We have phenomenal tax benefits. If you're investing in a retirement account, you don't gain those tax benefits. So some folks like who are getting phenomenal returns in oil and gas, but have a lot of risk. We could be going to war and now they're worried about losing it, right? They want to diversify those returns over to something like build to rent so they can take advantage of those tax benefits, right? So they're
Yeah.
reducing the risk in the one area, but they're bringing it into another area that offers more incentives to continue to build their portfolio. Andy,
All
go
right, so
ahead.
let's just say we've got investors here that are currently working, maybe a tech sales or some company. They've currently got their own, 401k. Is there anything that those people can do today? It used to be that you know, you had to kind of open something separately because your employer had that control. It maybe Kylie, there is or Bethany, I don't know if this is something in your experience. Can that person in tech sales do anything about their retirement?
Kylie, you're
We lost
muted.
you, Kylie, yeah.
Go for it, Bethany.
Okay, so they do, a lot of times it will depend on the company because different companies have different options. So sometimes some companies will allow you to actually do a direct rollover right from your retirement while you're still working into another retirement account. Very few companies do that, but it is an option. Other companies will you can always take a loan, but your loan's only going to be capped at, it's going to be capped at like 50K. You can't take more than that. So other times what you can do is you can set up your own self-directed IRA. There's going to be limits on how much can go in there. And Kylie knows these limits better, but it just provides another tool.
We lose Beth?
Did we lose
And
her?
she can actually,
Oh,
as
there she is.
this X amount to this
Oh,
other one as well. She's back.
AI Beth is coming in and out.
you're back.
So let's get the real one back here. You got to
Oh,
go back about 15 seconds. 15
oh,
seconds.
yes. So I was just saying that if you set up a self-directed one, you can direct your HR team to allocate a certain portion of your check directly to your company sponsored one as well
Okay.
as your private one. And that can come out pre-tax dollars too, just the same. Or if you set up the Roth one, either way, they can do that for you. Because a lot of times it's easier if it's taken out before you see it, then you don't spend it, right?
Yeah. Okay. All right. Thanks, Andrew.
All right, hey, we got a question, good question from Jeff, and you all have answered this in some ways, but let's get into it deeper. How do common retail investors get involved in investment opportunities in private companies or private credit or private equity?
Go ahead, Kylie.
I was going to say, I'm letting the professionals that have been in it 25 years get in that question. So I'll let you guys dive deep.
Yeah. Um, what's interesting is this is probably a blind spot that I have. I've been in this world for 25 years, right? So you kind of have investment decks that come across your desk or PPMs that come across your desk, and you kind of feel like, hey, it's probably an organic version. One thing that I would suggest for people that are looking to invest in private is just take a look at, some of these sites that are out there now that are real estate sites. Just take a look, kind of compare what the returns are. Like, for instance, we know when we're talking to investors, we know pref equity is going to cost us 14 to 16%. We know that if we're going to get a construction loan, it's going to be about 11 to 12. And if we refi, it used to be the old days we could refi into 5%. Now we're refining into 6.5%. So you kind of get you're able to triangulate what are the differences. But the thing that I would say is, in all of those websites, companies that do that, there's always kind of the disclosures, and then you're looking into the team, right? The track record is obviously what we talk about, the most important thing. If we're going to do any comparison to the private versus the public, the expectation is that private company that you're investing in is reporting regularly, right? That you are, instead of that kind of voting machine that I referenced earlier that the public markets are doing, you've got this weighing machine. Every year you're saying, hey, are these guys doing what they said they're going to do? Are they on track? Are they reporting? Are there other options? You have some of that agency. So I would just kind of, triangulate through some of these sites, and then as you're learning more, you'll see what makes sense for that particular operator or business and what doesn't. Bethany, what would you suggest?
Well, and I think some of it too is every fund, every investment group will always have a minimum. There's always a minimum to get started. And some of those minimums are a dollar figure, and some of those minimums are whether you're accredited or not. So those are the two basic questions that you have to know first and foremost. So understanding if you are accredited or not, and these are government terms. We didn't make these up, right? The government said you're accredited if you make over $200,000 a year for 2 years in a row consecutively, or 300,000 as a married couple, or it's got like 3 different things. That if you have $1 million of net worth beyond your primary residence, another one you can actually have it now based on experience. Then it claims that you're accredited and you can go after, or you can invest in 506C offerings. You'll have to prove that someone verifies it. Easily done, not a problem in that respect. If you're not accredited, then if you've done, maybe you bought a rental home, you've gained a little bit of experience. Maybe you've done some other investments, maybe you bought some crypto, different things like this. Then the government deems you as what's called a sophisticated investor. The difference is for you as a sophisticated investor to hear about these offerings, the accredited investors, those offerings, those 506C offerings can be advertised. So those are what you see publicly. When you actually see an offering out there, that's
Yeah, I think we lost Beth again.
because it's 506C only for accredited. Is going to hear of an offering is through the relationship. So you have to have that relationship first. That means Kylie needs to know about them. Andrew needs to know about them. They need to share the offering after they've determined, okay, this probably is a sophisticated investor, because we have to follow guidelines that the SEC puts out there as well. There's always somebody watching our back just the same, and we get audited and all of that. So recognizing you got to know what you can get into, when you can get into it, how you can get into it. So some of the funds, like our fund, we have an opportunity. Some of the offerings can go down as low as 25,000, but for it to come in at 25,000, you already had to have had an investment with us prior to. Yeah. Other times it may be, we've got families that they're working towards getting their accreditation. So they're coming in on the debt side. And then what they're doing is they're taking all of their earnings on the debt side. because they don't have to be accredited. And then they're taking those earnings and they're putting it in our treasury account, and it's building interest. So it's not sitting there doing nothing, it's still working for them. And then when they get up to that 50K mark that they want, now they're reallocating it, right? So it's talking to folks like Kylie and myself, talking to folks like Andy, talking to Andrew. It's getting around people that are doing something different, not standing there talking to, the coworker at work who doesn't even have a retirement account, right? It's getting around other people.
Well, and I think you
So
make a really great point there is talking to people that are doing something you haven't or beyond where you are. I think a lot of us, when you're in your rooms with your families or friends, they're not in the same space as you are. And we tend to take advice from those people without recognizing that may not be in the right direction. So great point, Bethany.
Yeah, you know what? I gotta hit on that, Kylie. Do not tell your friends that you're looking to invest in private real estate
Yes.
because they've seen you in your underwear, with the lampshade on, and they just don't think that you are going to be able to do this. But I can assure you that if a dummy like me can do it, you can do it. I also would say, I think Jeff might have asked a question. Give us a call because there's a lot of resources that we have. One kind of trend that's interesting over the last few years, really since 23, 24, when multifamily started to kind of have really hit quite a few obstacles, is that there's a lot more kind of private investing opportunities where you'll just get a cash flow, and maybe that potential lend you become the loan, you become the bank, and you might be able to, you might not get a first trust deed, but you might get a high net worth individual that says, hey, I would love to take your $100,000, pay you 12 to 16% over time, and you can blend that with maybe some of your long-term stuff in oil and gas or other funds. So there's once you get in this world, you realize how many opportunities and why it's been kind of hidden from a lot of us folks, because there are so many opportunities. I referenced that kind of Goldman Sachs. If you get in the room with the private equity guys and you've got more control over these private companies, and it's not being dictated by the sentiment of the market, those leverage returns start to really, really work in your favor.
so one thing I heard there, and it's maybe the starting point, is relationship. And so someone is coming in and they're like, hey, where do I start? The good news is there's more out there to learn and to grow and to build relationships than there's probably ever been. What are some of the sort of entryways that investors have found you all in starting to build that relationship?
I think when you're in this a while, people they consider, hey, what have you done for me lately? So if the projects are performing and they're getting their monthly returns, or they're getting their loan repayments, whatever that is, I think that speaks volumes. I think if you're just starting out, obviously there's going to need to. I would recommend partnering up with somebody that, as Kylie mentions, a little further along than you. To me, I think you're kind of putting yourself in a really tough position by trying to prove that track record without it. It just makes this world so much more difficult. But again, it's like everything in life. There's a relationship piece to it. Kylie, what were you about to say before I interrupted you?
Well, I think relationship too is also not doing it blindly too, right? Like it's really easy to believe someone if they've got all this hype and excitement and experience, but it's still being able to do that due diligence enough to understand and not just throw all your money into something right away, right? You can always start small as well, but it does come to that relationship, and over time, I mean, it takes a long time to see some true colors, understanding business ethics, all those things. So it's taking the time to make sure you're in the right relationships when you're making those connections.
I think too that trust is sometimes earned, right? It might initially be given, but it's also earned and retained. So like Andy mentioned, as our projects and things have gone on and people are getting paid and things are rolling through, right? We're earning more trust with them. But at some point they still had to decide, okay, Bethany, I'm going to take a chance, right? So we have when you've been in the industry for any length of time, you always have good deals and bad deals. It happens, right? So making sure that an investor really understands, okay, what are the risks that are involved versus it's one thing to say, oh, we're going to give this and this and this and this. A pro forma is just that. It's a speculative based on this. We believe this. But at the end of the day, the dollars and cents of it may not match. So you have to be willing and understanding of that risk. And if they haven't done a good job and you don't understand that, then emotionally it can be a very hard thing to put faith and trust in that person. So I think if they've done a good job and they've really helped you understand that and gain that knowledge, it makes it easier. Obviously, the moment you start getting paid, that makes it easier. When our investors, year one, their 50K investment goes in, and year one, they got 100K write off on their taxes. They were pretty excited, right? They didn't even see a payday, so to speak, but the tax savings alone was worth it because that year their oil and gas investments were killing it. So they needed that write off. So understanding, I think, is just as imperative. But when we stop and just realize to get started, it is getting out there, right? You can't just hide in your little bubble and expect it. It's getting on a webinar like this. It's going to a local, real estate meeting or going to a conference. Sometimes I have seen this happen many, many times. As a couple, use it as an excuse to take your wife out on a getaway. It's wintertime, it's yucky in Oregon, right? Hey, honey, let's go to Arizona. And then, by the way, we're going to go to this real estate conference. It'll be great, And she shows up to some of the things, you show up to some of the things, you actually have intentional conversations. You start talking through that. I think as women, Kylie and I deal with this a lot. Women overall have let so many of the men in their life kind of I don't want to say run or control, but they just dismiss it. I don't need to think about it. It's their job. They're thinking about it. And then they find themselves divorced and on their own. And now it's all coming back full circle. So we feel like we're constantly having to educate women of, look, you need to get involved. You need to understand your husband may or may not want your input. I'm not sure. Every dynamic is different. But if you understand he's trying to reduce the risk and he's aiming for this goal, and maybe that's not aligned with what you guys are trying to do, and you find something or you hear of something that might help, if you can give him that insight, now you've provided an asset to him and you've been a resource, and now you can have a conversation. Doesn't mean he's going to do it, doesn't mean your structure is going to change, doesn't mean any of that. But I think we just need to be more intentional with our time, intentional with our resources. Everybody works hard for their money. And the more we choose to keep very intentionally, because we're putting it in very strategic places and ways, the faster it will grow for us. And your capital will always be the hardest worker. It can work 24/7, right? I can't work 24/7, but my capital sure can.
All right, okay, one more question before we land this plane today. So now let's say, okay, I'm ready to execute. I'm ready to move money. I'm ready to invest in real estate. Explain a little bit, Andy, what some of the main structural options are out there for how retail investor could invest. And that's part one. Part two is, are you seeing any kind of moves over the last couple of years in preference from your investors?
Yeah, I think in general, the preferred return, as they call it, that means that, investor that would be paid, it's 9% before everybody else is paid. That was kind of a sought after investment, for a while. In multifamily, kind of, they realized that that's probably not coming, that distributions are probably not coming. They started to say, hey, look, why don't I become a private lender then if I want my cash flow? Or as long as I'm not getting my distributions, why don't I go with a team that's got some experience and go after some larger equity type deals where I've got maybe some front end, maybe I blend some cash flow private lending with an opportunity to invest for, in our instance, a development project or an oil gas project that's got an upside with the team that's been able to navigate the private equity world. So that's probably what I would say that's been a trend. I also think that as we talked maybe at the beginning of the call, there are ascending markets. It used to be that you go to, LA and New York were the primary, markets, right? And then it became, hey, let's go to Phoenix and let's go to Austin. Those are the hot markets, right? And then you kind of see as every year elapses, there's more and more building in those markets, and now they're sucking out the returns and the residents of the ones that came before them 5 years. So we kind of focus on, let's find strong, growth markets that have an economy, they're balanced. It's not, one oil, gas, or air, or, a base. It's, healthcare and food services and tech and all of that. And let's find those markets that are maybe secondary, tertiary markets, but we know that we've got kind of this moat of, unfair advantage. And you can't get that everywhere. But like I said, in some markets it's ascending, and some it's not. So that's probably where I've started to see the guys that were only in Dallas, only in Austin, only in Phoenix are now starting to take some of their bigger checks to some of these secondary and tertiary markets.
Anything to add, Kylie, Bethany?
So I think when we stop and ask ourselves, what are we trying to do? If we're honest with ourselves, some people are trying to build cash flow. Some people are trying to build a big nest egg. People have different goals in mind. So when we hear about, trends or things happening and this and that, some of the people squawking the loudest, it was because they had a different goal in mind and they didn't do their due diligence and they invested in something that didn't meet that goal. So then they're disgruntled. Sometimes at the end of the day, we want to ask ourselves who's in control of that. So when we are trying to create cash flow, investing in something like Andy talked about, where a multifamily was not creating cash flow, then that's not a good match, right? And we would need to reallocate. So I think one of the trends that I saw the most was people realized, wait, I do want cash flow. That is important to me. And so what we've seen is more and more folks coming in on our debt side because they can come in, they can create the cash flow, and they can either use it to build up bigger buckets that they want to use to, say, put into a bigger multifamily project, or put into oil and gas, or put into something else. But they wanted the cash flow. They wanted quick wins. It was a way for them to build trust with somebody. It was a shorter term, anywhere from 18 months to 36 months usually. And so we saw a bigger increase in that. So trend wise, we definitely saw that. I think people are learning the value of experience. They don't always understand that a market cycle is generally 10 to 12 years. If it's 10 to 12 years and you're working with somebody who's only been in the industry 2 to 3 years, they've never cycled. If they've never cycled, there's a whole different learning curve that they're going to have. And they may potentially have already set themselves up for defeat, because you make your money when you buy, not when you sell. And people don't understand that if you haven't been in the cycle long enough. So recognizing the value of experience, I think people have learned that in the last couple of years. And so we are seeing a shift in that. I do know that as a retail investor, you really need to ask yourselves questions that most people aren't. Back in the day, Kylie and I deal with this a lot. We just did another masterclass on it. Nobody ever heard of being the bank. What does that mean? Yeah. How do I be the bank? Right? I'm not Chase Wells Fargo. I don't have millions of dollars. How does this work? I don't know anything about it, but they're hearing the term. So when they hear something, but they don't know what it means, they just stop. They just don't go further. So we spend a lot of time educating, and trying to get people to understand you do have control, you do have options, and you can be the bank, the one making the money. So how you do that, what you do that, where you do that is different. So some people are doing that through, they have maybe a portfolio of 30 single family rental homes. They've created cash flow from these rental homes. So what they could do is they could live off that, or they could invest part of that into something else that creates a second cash flow. And then they can do the same thing, live off part of it and create a third. And so
Oh, we lost Bethany. She was just getting to
So
the good
close.
part.
We were so close.
So close to the end. You know
so
what?
they're
One
learning
thing
that
I
they're
would
creating
say.
multiple streams that
Oh,
they can
you're
actually
back,
live on.
Bethany.
Yeah, we're back. We were just about to close without you, but I wanted to hit on your experience point. I was actually, my barber was cutting my hair, and I was like, oh man, I'm losing everything. It's all gray. He's like, hey, I'm telling you, experienced partner. There's a lot of guys younger than you that are asking me to put some gray in it. I said, no, you haven't earned it yet, bro. You're gonna have to wait and get that gray hair for real. So the gray hairs and all the kind of, warts and all that stuff, adds up, especially in down cycles, right? Like they're the winning's kind of the best deodorant, but when things get tough, you got to really have somebody, she still looks young, of course, but she's got some experience in wounds there. But Andrew, this was awesome, man. Thanks for making this happen.
Seriously,
Yeah,
thank
yeah.
you.
Thank you all for joining, Kylie, Bethany, Andy. Thanks for bringing your expertise to this. And reality is that investing in real estate, it's not for everyone. But I know each person here is open to getting on a strategy call if you want to talk about reallocating some of your portfolio, and also exploring how you can use your retirement account funds to invest outside the stock market. If you have interest in doing that, Bethany, Kylie, what's the best way to reach you?
For our email, so if you want to do info@empc.com is how you can get a hold of us that way. And then our phone,
Kylie,
go ahead.
info
Did I
at empcfund.com.
fund.com. Sorry, I said that too fast. I'm a quick talker these days. And then if you want to get in touch with us, we can put the link for, we can give you guys a link for our book a call. And then if you want our number, it is 352-525-2428. I should have that memorized by now, but I do not.
And that's a big deal, Andrew, because usually I think they charged us money for it. So you guys are doing this for free for the legacy audience, or this is you guys are charging them arm and a leg like you do everybody else?
Oh, when did we charge an arm and a leg? Really? Come on.
All right. So this is going to be a free kind of, if they're serious investors, a strategic call. That's awesome.
Yep.
All right,
Very
well, Andrew,
good.
you know how to reach us. LinkedIn, Legacy Acquisitions, try to flow everything through there. We do have a couple of resources, Built to Rent book, and also would love getting on the calls with anybody that wants to they're kind of figuring out what their next move is. We'd love to chop it up with them.
Very good. Thank you all. Thanks for joining. Make it a great week. Blessings.